观众朋友们，大家好。美东时间3月20日周二，美联储联邦公开政策委员会结束了为期2天的货币政策之后，他们决定将利率维持在5.25%到5.5%区间不变。自2023年7月以来，该区间就一直维持在5.25%到5.5%的范围之内。与此同时，这也是23年以来的最高水平。另一方面，美联储还宣布将2024年的美国 GDP 增长预期提升至2.1%，比之前2023年12月预计的1.4%有大幅的提升。那么，市场对于美联储政策3月的利率政策有什么样的解读？本期直击华尔街栏目，我们再次回到纳斯达克，采访纳斯达克高级分析师 Massud Ghaussy， 请他来为我们解读市场的政策。Hi Massud.
Hi Rui, thanks for coming to Nasdaq. Welcome back. It's great to talk to you again.
Thank you so much for joining us the show again. So the first question is about the Federal Reserve's March meeting. With the Federal Reserve decided to keep the interest rates unchanged in their March meeting. So what impact does this have on the market volatility? And also, what industries or sectors will be affected most by this policy?
So big week for central banks. As you mentioned, Fed just spoke yesterday. And to your first question in market volatility, whenever central banks unleash liquidity, generally speaking, it saps market volatility. The Fed's position and their messaging was considered to be dovish. So they're releasing a little bit of liquidity in the markets. And they're easing financial conditions. Monetary policy is becoming looser. So as a result, this will unleash this will sap up market volatility. So expect subdued volatility going forward. In terms of your second question with respect to sectors, I think at worst, the current momentum trade will continue. The momentum trade being growth companies, specifically focused around the technology sector. Also known as the Magnificent Seven stocks, and in Europe, the granolas, expect continued outperformance by these type of companies, by this sector. Also, if you look across the markets, anything that screams growth or quality has been outperforming. So expect these factors and these strategies and these types of stocks to continue to outperform at worst. At best, given the fact that the Fed has tilted dovish, expect the entire market to actually rally. Over the last 2 days, this morning and yesterday, we saw global markets rise. So this should be a net positive for the entire equity markets. However, given that they will be looking to lower interest rates in the future, this should also help the bond proxies, income sectors, so sectors like utilities and real estate.
So according to Federal Reserve's post-meeting press conference, and also the Fed's dot plot, what other information is sent out to the market?
So there were 3 key messages from the Fed. One, there will be 3 rate cuts this year, despite the fact that inflation momentum is picking up, so a little bit of a concern there. 2, that the Fed is not concerned about the recent uptick in inflation. Both PPI, CPI, PCE numbers have been coming in slightly above expectations. There's inflation momentum picking up in the markets. Copper's up. Bitcoin has more than tripled. Global stocks are higher. Break-even rates are moving up. So inflation momentum, again, is picking up. Small business, their price index has been going up. So despite that, the Fed is not too worried. And thirdly, the third messaging is that the balance sheet reduction will slow down. So all these 3 key messages that were sent out by the Fed signals a more dovish stance in easy monetary policy and in a pretty loose financial condition environment.
So according to a CNBC survey, and also at the beginning of 2024, the market consensus is that the Federal Reserve may cut interest rates like 4 to 5 times. But right now they're saying they're going to cut it 3 times. So what do you think are the underlying factors that cause this change?
Yeah, so to your point, I think at the peak, this was early January this year, there were approximately 7 rate cuts priced in by the market. So the markets were aggressively pricing in rate cuts because the market took the view that economic fundamentals will deteriorate in 2024. But that scenario has not played out. The economy is doing actually better than expected. Inflation had been coming down, although now it's ticking up slightly. So given those two factors, there are approximately 7 rate cuts priced in. However, over the course of the last 2-3 months, the markets have been now pricing in 3 rate cuts in line with what the Fed has announced. So yeah, 3 rate cuts have been priced in.
So what long-term implications do you foresee from the Federal Reserve's monetary policy made in March on the market as well as the overall economy?
So I think the biggest risk with yesterday's Fed messaging is, one, inflation will pick up. As mentioned earlier, inflation momentum has been picking up. If you look at gold price, as mentioned earlier, Bitcoin, copper, small business indexes, price index, global stocks all have been moving higher. And I believe that potentially this could continue to push inflationary pressure higher, and at which point the Fed has to step back in and tighten monetary policy. So negatively put, this is kicking the can down the road and bringing inflation back. So that's the inflationary aspect. From an economic aspect, it's probably not that much clear as to how these actions will impact the Fed, but at least the economy will be on a short-term sugar high. This will help boost economic optimism and sentiment, given the fact that the Fed has been tilting dovish. So I think those are the two impacts on the economy and the markets.
You just mentioned the inflationary pressures might be a risk, and at one point they may have to raise interest rates again. So do you have a timeline for that? Like when?
It's really difficult to pin down a timeline. As you know, the world is a very unpredictable place, and narratives have been shifting, as you mentioned, have been shifting quite aggressively over the last year. And one of the constant themes over the last 2 years is a constant shift in narratives. And a reason why investors have generally been nervous and have been focused on quality stocks. So over the last 2 years, quality matters. We have seen investors focusing on names, specific stocks that have strong earnings growth and also with strong balance sheet. And as a result, it just goes to show that it's a difficult market to predict where things are going, and investors are generally nervous also.
If we look broader to the global scale, like we look at Bank of Japan, they just ended their 8 year of negative interest rates and made their first interest rate hike in 17 years. So what impact does this have on the global market, the global central banks?
Firstly, I think it's good news that Bank of Japan is finally tightening monetary policy, because inflation is ultimately a monetary phenomenon. It's too much cash chasing too few goods, and it's usually unleashed by easy monetary environment. And it looks like inflation is starting to pick up in Japan. So to curtail inflation, it's probably a good move to start tightening the monetary screws, although this is happening at a snail's pace. So that's one. Secondly, a decade-long ultra-cheap monetary policy in Japan has unleashed a massive yen carry trade. So basically, investors borrow in yen because interest rates are low, and they invest globally elsewhere. So this fuels inflation globally. Now, with that transitioning back into a more tighter monetary environment, this should most likely subdue inflationary pressure, but it is moving at a snail's pace. So so it's hard to predict how it will impact inflation in the long term, but at least it's moving in the right direction, I believe.
Right now, we're standing at the end of Q1 2024. Time flies.
Yes, time does fly.
Yeah, last time when we spoke to each other, it was last year, the interview. So which industries have you seen a significant of investor inflows?
Yeah, so I sit at Nasdaq Investor Relations here, and we are the market leader in investor relation market surveillance, stock surveillance. And based on the flow data that we're looking at, as mentioned earlier, mimicking performance, some of the strongest areas of flows that we've been seeing is the technology sector, one. driven by semiconductors and the AI boom, which has been taking place since last summer. So that's one. We're seeing also pockets of strength within biotech, given the GLP-1 and also the GLP-1 and also small cap biotechs underperforming for a substantial time, finally mean reverting due to better environment. Financials have also seen an uptick, although it's focused more on the bigger companies as a result of more clarity in the interest rate environment and interest rates moving up. So those are kind of three sectors where we've seen positive flows. Also in terms of factor, the growth factor, as mentioned again, companies that have been increasing their earnings with strong balance sheets, they're seeing good inflows. So investors like that. In terms of specific areas of weakness where we're not seeing encouraging inflows is the utility sector, real estate sector, as interest rates have gone up. And when interest rates go up, these sectors are adversely affected by higher interest rates.
So looking ahead to Q2 2024, is there any substantial trend that investors should be aware of?
The biggest risks in the market currently, as per various investor polls, two things stand out. One, inflationary pressure building. And the second one is an inflationary pressure builds. This will push yields higher. And once yields start going up, and at some point it must, this will probably hurt stocks across the board. So that's one risk. The second risk is commercial real estate. And this is a post-COVID transition, structural changes. And for quite some time, investors have been mentioning that commercial real estate will be a source of risk. Now, how that plays out is very difficult to predict. The world is a difficult place to predict, obviously. But this risk may manifest itself in some form of a credit event, some default event. As to how that it plays out and when, it's difficult to predict, but those are the two sources of risk.